Are you looking to buy a house and are very confused about all the different loan options? Well, keep watching and I'm going to go through all of those with you. Hey everybody, my name is Devren Cook and today we're going to discuss your loan options when buying a house. There are about 4 or 5 that we're going to go through and I'm going to help you break it down and really just explain very simply what they mean, what they are, and what you need to do in order to get that loan. So the first loan that we're going to discuss is what's called a conventional loan. This loan is very common, and this loan you're going to need to have at least a 620 credit score, although this may vary from lender to lender, so check with your local lenders. But typically 620 or higher, and you're going to have to put at least 3% down on your house. Whatever the purchase price is, if it's $200,000, you're going to need to put at least $6,000 down. Two of the greatest benefits of conventional loans is one is you're not really going to have much criteria as far as what condition your house needs to be in. With some of the other loan options we'll discuss, your house has to be in pretty good condition. With this option, it could be a bit more of a fixer-upper and it will still get approved and appraised, so that way you can get final loan approval and buy the house. This is also really good for investors because they can buy a house with a conventional loan that's a bit of a fixer-upper and they can go out there, do all the work and sell the house and make some more money. However, they're going to need at least 20% to put down on the house when they're buying it strictly for investment purposes. And the last great thing about conventional loans is when you get to that 20% marker, when you have 20% equity in your home, whether it's over the years as you've been building equity or whether it's initially right up front as you're putting 20% down, you will not need to have PMI, which is just private mortgage insurance. What PMI does is it's essentially an insurance policy for the lender. In the case that you were to default, they're going to be able to recoup some of their investment through that insurance policy. The reason you have to have PMI under 20% is because you're seen as a more risky investment. So those are all the great things about conventional loans. The next one we're going to talk about is FHA Loans. FHA Loans, which stands for the Federal Housing Administration, is basically a loan backed by the US government. And with these FHA loans, you can have a lower credit score. Typically, you're going to need at least 580. So if you're not quite at 620, you're somewhere between 580 to 620, you can go ahead and get one of these loans. However, it does have a couple drawbacks. The number one is you will have to have more money down. You're going to have 3.5% down versus just the 3% minimum with conventional loans. Not a huge difference, but it's a difference. The second biggest thing is the house has to be in good condition. It can't have paint that is all cracked and chipping, and it can't have foundation issues, and there's all kinds of stipulations and criteria that the house has to meet when you purchase it in order for you to get the loan and get approved for that house. And lastly, if you want to get rid of PMI, once you get to that 20% equity marker, you will not be able to do this with an FHA loan. You'll have to refinance. If you have the house and that loan for the 30-year period that you have the loan, you will be paying PMI the entire time. And so your best option is to get to that 20% and refinance with conventional, refinance somewhere along the way. The next option we have is a VA loan. These are Veterans Association loans, and they're to help veterans get into a house. These loans are awesome because you only have to have a whopping 0% down on your house, which is great and it really helps people out. However, you will have to have typically that 620 credit score or higher, and you're also, just like FHA loans, going to have very strict requirements as far as the condition of the house in order to get approved for that loan. And lastly, USDA Loans, which stands for the U.S. Department of Agriculture. These loans are awesome as well because you only have to have another whopping 0% down on the house. However, they are strictly required to be in a certain area. And these are typically more rural areas, out in the wilderness, out in the boonies, out in the desert. Who knows? Not really. But they are a bit farther out from the city sometimes. And so if you are looking to buy a house in one of these areas, check with your local lender or your real estate agent. They'll be able to help you find one and you can get into that house with 0% down. Keep in mind, with these VA loans and USDA loans, you still will have closing costs. So it's not just a free house that you're getting nothing down. You're still going to need about 2 to 3% in closing costs that you need to be expected to pay. So that's it as far as the loans, your conventional, your FHA, VA, and USDA loans. If you have any more questions, leave them in the comments down below. Thanks for watching. Remember to like and subscribe, and I'll see you in the next video.